Okay, hello everyone. I hope everyone's having a great day. Welcome to the first part of the Beginner's Guide to Trading by Enigma Trading Group. That's us. My name is Mark. I'll be guiding you guys through this PowerPoint and talking to you guys about this entire thing. But yeah, so without further ado, let's get started. So today we're going to be looking at the overview of Forex and basic terminology. Those are the first two things we're going to be looking at. I want to split these these little contents into different videos, little like 10-15 minute videos, in order to, so it's like more bite-sized chunks rather than overloading you with so much information and it being a bit being a bit useless anyways, because people lose focus and so on and so forth. So yeah, we're going to talk about the overview of Forex and basic terminology for now. Just let you guys know, just clarify before you guys get started and before you guys put a lot of time into this. This is not a course or a video for you guys to become profitable, right? This is not the one where you guys be looking for, if you guys are looking for strategies, this isn't a video for you guys. I just want to make that clear now. This is mostly for you guys who are just wanting to get started with Forex, where what are things called, what Forex is in general, what a Forex currency pair is, looking at how to analyze at the most basic way, knowing how to use basic tools, the risk management, and picking a broker. A lot of people struggle with picking a broker and setting up MT5. So these are all being different parts, and this is the first part where we'll be looking at Forex as a whole and the basic terminology. Okay. By the end of this video anyways, you guys should know what Forex exchange is in the real world and identify it in the real world, and be able to kind of follow along when I'm talking about how I analyze and talking about my analysis in general. You guys be able to follow along quite easily, and with being able to understand what are the words coming out of my mouth basically. Have your trading view chart set up and know the basic tools and how to use them, MT5 and MT4 and MT5 connected, and be able to analyze, execute, and manage trades. So today, so by the end of the entire course, you guys should be able to do all of them. Okay. So who am I? So as I said, my name is Mark. I am part of Enigma Trading Group. I have been trading for just under 4 years now, about to actually be 4 years this month. So exciting stuff. I'm actually a full-time trader now. I have been for a few months now, but I have been profitable for almost a year. Consistently profitable, that is, for almost a year. But yeah, so I know that sounds like amazing stuff, but I'll show you guys why it's actually easier to become a full-time trader in Forex in today's day and age than it was obviously all the way back then, later on through the course, if I remember. But yeah, but that's a little background for myself. By no means do I know everything about Forex, or by no means am I better than the person you look up to in the Forex industry. I'm just here to show you guys my knowledge and to show you guys the knowledge I have gained throughout the 4 years, as I'm pretty sure that I know the basics when it comes to Forex at the very least anyways. But yeah, without further ado, let's get to it. So market overview. What is Forex, and what is Forex in real life? So Forex or Forex exchange, as you guys may know, is a process where you use one currency in exchange for another. As simple as you using US dollar to buy euro. If you're going to Europe or something, if you're going to France or something, you wouldn't want to have your dollars there because they wouldn't really take it. So you want to get some euro so you can actually buy stuff in that country. In terms of volume, it is by far the biggest, with a daily volume of around 6.6 trillion by the time of making this video. It could have grown because when I started, I think it was around 5 trillion or something. So it has grown quite a considerable amount, especially with the retail traders jumping on as well, giving a decent boost, especially with lower commissions with brokers as well. So what does that mean? So that means that in terms of getting a slice of the pie, you don't actually need that much. You just need a 0.0000001% of the pie. You make loads of money, and it means also there's loads of volume in the market where you won't be struggling to put in your positions, especially if you're a small trader. You won't have to struggle putting positions and lot sizes, and yeah, it's easier for you guys to trade. Example of it in real life, as you can see here, money exchange. So how does it actually work? Let me show you guys. So how does it actually work? So in terms of simplicity's sake, I'm just going to use rounded numbers rather than using the actual exchange rate, because in terms of maths, I'm not the best. So I'll show you guys now. So let's say it's a 1-to-1 euro to pound. Okay, so this is the euro and this is the pound, and let's say you have £100 over here. Therefore, if you want to go to Europe, you're going to exchange it for euros, and you're going to have 100 euros as well. Very simple. But let's say the value of euro has increased against the pound, right? So for every euro, you now get £2, which means the value of the pound has decreased because you can get a lot more of them for less euros. So let's just put that into diagram. So now you get €1 for £2. So that's still euro and that's still pound. So let's say you went to France and you had 100 euros to begin with, and then you came back, we didn't spend any money at all, and by the time you got back, this is the new exchange rate. So what does that mean? So when you exchange your 100 euro, okay, so 100 over here, what do you have to do in order to get to 1 to 2? You have to times that by 2, which means you have £200. So what does that mean for you? It means you started off with £100, so take that away and you get £100 profit for going on holiday. Great stuff. Obviously, this huge move does not happen in Forex ever. If I you know, these double, it doesn't double overnight. It doesn't move 100% of the time. It only moves realistically on average. It's a volatile market, I would say, a little bit volatile, less volatile than others, but it's still volatile and there's a lot of volume. However, it doesn't move 100% in a day. It doesn't, you know, lose 100% of its value in a day. It goes up in little movements, little increments called pips, which I'll tell you guys about later. But basically, that's the basics of it, right? So if you exchange one currency and hold it against another, and then you buy the other currency, buy the other currency back which you started off with, and your currency went up in value, then you made money. Okay, I hope I made that simple, and I hope I didn't confuse most of you guys even more. But that's basically the simplest way of showing what Forex actually is. And that is the example of it in real life. So this is a real life business. This is a real thing that happens day to day, day in and day out. Okay, so it's not just a game that you play on your phone or your thing. This is actually real. It's an actual market. And yeah. So basic terminology, so different ways to say the market is going up: buys, longs, bullish, and bearish. So in terms of using it in a sentence, I would say if I'm looking for buys in GBP USD, I would say, guys, I'm going long on GBP USD because this market looks very bullish and there's a lot of bulls participating. So basically, in layman's term, what I'm saying is, guys, I'm going to go put like buys in this market. So I'm going to buy pound against the US dollar because it looks like it's going up, which means bullish, because there's a lot of buyers participating in this market right now, which means bulls. Okay, it's just simple terms, basic terms to use, right? Different ways to say the market's going down. I don't know why he's got a capital A, bit of a typo. Sell, shorts, bearish, and bears. So again, using it in a sentence, if I was to sell the GBP USD, which is pound US dollar or cable, I'd say, guys, I'm going short on this market because it's looking very bearish right now and there's loads of bears participating in this market. Okay, words you hear me say a lot. Okay, so lot size, spread, and leverage. Okay, let me explain those things. Okay, let me explain those things to you guys. Okay, so lot size. That's it, lot size. Okay, so lot size, what does that mean? So for, let's just start off with the basics. So one lot is equal to 100,000 of a currency. So if you're putting a one lot trade in, if you're a one lot trader, as most people would say, that means for every trade you're putting in, you're buying 100,000 whatever currency of it. Okay, so for example, let's say you're trading GBP USD and you're putting a one lot in. That means you're buying 100,000 pounds of US dollar. That's what it means, okay? Obviously, that's a lot. That seems like it's a lot, but bear in mind, these markets only move 0.00001% at any given time. So you're not losing 100,000 pounds in a second like that. It doesn't work like that, okay? It's just because you need a lot of money really to make a difference in the foreign Forex industry, because the moves are so minuscule. So you need a lot of money, and this is where leverage comes in. Because let's say you only have £500 to trade with, which I would say it's not a lot. Okay, so don't think that you guys are going to be able to make hundreds and thousands of pounds with £500. That's not how it works. But let's say you only have £500 to trade. Okay, realistically, you won't be able to make any money at all, not even a penny, with £500 unless you have what's called leverage. So what does leverage do? Leverage basically makes you borrow money using the money that you have already in a ratio. So basically, if the leverage is 1 to 500, that means you have 500 times or whatever you have in your account. So let's say you have 500, so you would have to do 500 times 500, which is 250,000, I think. Yes, 250,000. I'll go with that. I'll go with that final answer. Okay, so 250,000 of buying power. That means in terms of lot size, if you guys can guess, how much lot size can you actually put with 250,000 of buying power? Right? You guys can put 2.5 lots at most at any given time. That doesn't mean you're gonna be able to lose 250,000. No, you're only gonna be able to lose the total money you've put in, which is £500 at any given time. I have never witnessed anyone losing so much money where they owe the broker money, mostly because as soon as you lose your principal, which is this £500, they cut off your trade entirely, and it has an automatic stop loss to cut off your trade, and you get what is called a margin called. That says call, margin call. I don't know if you guys can see that, but yeah, it's called margin call. And basically it's where your entire principal gets wiped out. And the last one is, I forgot what the last one is, spread. So spread is basically how the broker gets paid to a little bit. Okay, so basically, let's say you enter at this black line over here. With spread, you say you're going buys. What they're actually doing is putting your entry a little bit higher than usual. Okay, that's where they're putting you at. They're putting your basically this is their little piece of the pie. Okay, and then what they'll do is, let's say you have a stop loss over here. They'll put your stop loss a little bit lower over here. It would spread if the spreads are really high. Spread also increases when the market is very, very volatile, because the algorithm that's taking your orders into account can't keep up with the amount of volume, and sometimes it gets your order goes at the very, very bottom of the pile, so you don't get filled in quick enough. That's what basically spread is. Okay, very simple. It's not really something you need to worry about unless you're really like scalping, which a lot of you guys really won't be doing 1 minute scalps, right? You guys are probably gonna stay on the intraday slash intra-week time frame anyways. But yeah, it's just little things that one, the broker gets paid, and two, if the algorithm is struggling to execute your trade quick enough. And what's next? So words you'll hear a lot from me: stop loss, entry, take profit, break even. Okay, so stop loss is basically where if you are buying, your stop loss would be below your entry price, and if that entry price gets hit, then your trade gets automatically stopped out, and you lose that however much money you managed for that trade. Okay. So let's say that stop loss is 10 pips and you bought, let's say, one lot for GBP USD, you would lose £100, if my math is correct, I think. But yeah, so that's basically how it works. Take profit is basically the opposite. So once it hits this level, you make the amount of money you expected to make, and you hit that take profit, your trade gets automatically cancelled and your trade is done. Break even is basically when you have an entry, it moves into your direction, you move your stop loss into your entry, and then the trade goes back into itself. Then you get tapped for break even, which means you lose nothing, you make nothing. Profit loss, simple as how much money you make, how much money you lose. Words you'll hear a lot from me as I talk a lot on Discord. Forecasting, it's me predicting what's going to happen in the future in the market, where I haven't executed anything. I have just analyzed it and looked at the market as a whole to see where the market could be headed next. Rollover is basically when I'm expecting price to roll over, so go down into an area that I was expecting. Sell / buy side potential. So when I'm selling or buying something, I'm saying it has so and so side potential. So if I'm selling something, let's say I'm looking at GBP/USD. GBP/USD has sell side potential, so I'm maybe looking at sell some shorts. And then candle close. Candle close is basically where where I'm waiting for the candle, the whole let's say an hour time frame for that specific candle to finish before entering my trade. Current highs and current lows. It's pretty self-explanatory where the current high of the market is and where the current extreme high of the market and where the current extreme lows of the market are, because normally you would see a lot of liquidity from each end of those sides. That's why, which I'll talk about liquidity, probably not in this one, probably the next one. But yeah, so that's basically it, guys. I hope you guys learned something today. If you obviously learned something, please hit the like button and please subscribe to get notified for the next one. The next one, as you can see here, a bit of a spoiler: common misconceptions. I'm sure you, if you guys want to see that, then definitely I'll see you guys on the next one. Thanks.